Okay, let's unpack this.
Let's do it.
Today, we're diving into the recent performance of, well, the world's largest home improvement retailer, the Home Depot.
Right.
We're looking at their third quarter fiscal 2025 results. And, what those very specific numbers tell us about consumer spending, the DIY market, and the housing sector in general.
That's right. And our source material here is the official press release, all that dense financial data that comes with it. Our goal for you is to get beyond just the numbers on the page. We want you to quickly understand the really crucial health indicators and, maybe more importantly, the headwinds that are affecting this retail giant. We have to cut through the jargon.
And the headline is, it's pretty clear right away. The Q3 results showed basically zero comparable sales growth.
Which is a huge deal.
It is. But the most surprising part is how the CEO explained it.
Yeah.
He pointed to a very specific external factor you just don't hear every day. We're going to get into that. And the big acquisition that's really changing their sales picture.
And what's so fascinating is how explicit they are about linking something like the weather or the lack of weather to missing their own expectations.
Yeah.
We're looking at everything up to November 2nd, 2025, and their projections for the rest of the fiscal year. And crucially, we have to talk about the GAAP numbers versus the adjusted numbers.
Right.
If you really want the clearest picture of how the core business is doing, you have to understand that distinction.
Okay, so let's start the deep dive with that Q3 report card. Give us the top line numbers.
Okay, so total sales for Q3 FY 2025, they came in at $41.4 billion.
Which, on the surface, sounds pretty good.
It does. It's a 2.8% increase. That's about $1.1 billion more than the same time in fiscal 2024. If you just stopped right there, you might think, okay, business as usual.
But you can't stop there. The devil is always in the details with retail, and the big one is comparable sales.
Always.
Can you just remind everyone why that metric matters so much?
Sure. It just strips out the noise. It takes away the impact of, new stores they opened, or in this case, a huge acquisition. It lets you compare the existing core business apples to apples year over year.
And what did the comps say?
Well, they told a very, very different story. Globally, comparable sales, the real measure of demand, were up only 0.2%.
Barely moved.
Barely. And if you looked just at the U.S., their biggest market, it was even tighter, a 0.1% increase.
So, effectively flat, stagnant growth in the United States. For a company that big, that signals a major slowdown.
A huge slowdown in organic customer demand, yeah.
So how did they even get that tiny sliver of growth? Was it more people coming in, or were people just spending more?
And this is where you really see the big shift in consumer behavior. The number of comparable customer transactions, it actually decreased.
Okay.
It was down 1.6%. So fewer people were coming through the door.
So the growth, that tiny 0.2%, it all came from somewhere else.
Entirely. It was all driven by the comparable average ticket. That went up 1.8%. So the average spend went from about $88.65 last year to $90.39 this year.
Okay, so that dynamic, fewer trips, higher spend, that points to something specific, doesn't it?
That does.
It suggests the DIY consumer, the do-it-yourselfer who's making smaller, more frequent purchases, they're pulling back.
Precisely. Meanwhile, the professional contractor, the pro, or maybe someone doing a very specific big project, they're still spending. They have to. They're less sensitive to price on essential materials.
So the DIY customer is feeling the pressure from inflation, from interest rates, and they're delaying projects. But the pro is what's keeping that average ticket up.
Exactly. The pros are buying the big ticket items, the lumber, the appliances, and that's what's propping up the number. It's a huge insight into who their customer is today.
Okay, let's go down to the bottom line. What about net earnings? The standard GAAP figures.
Net earnings were $3.6 billion for the quarter. That's a small but notable drop from $3.648 billion the year before. So diluted earnings per share, the standard GAAP number, was $3.62.
Which is down.
Down 1.4% year over year.
Okay, and this is where it gets interesting because we have to talk about the adjusted numbers. Companies use these to, paint what they say is a clearer picture. What is Home Depot adjusting for here?
This is so important, especially now that they're making all these huge acquisitions. They use non-GAAP measures, so adjusted operating income and adjusted EPS, and they do it mainly to exclude one thing.
And that is?
The amortization expense from acquired intangible assets.
Whoa, okay. That's a mouthful. Break that down. What does amortization of acquired intangible assets actually mean?
Think of it like this. When Home Depot buys a huge company like GMS, they're not just buying warehouses and trucks.
Right.
They're also paying for things you can't touch. You know, the company's brand name, their customer relationships, their technology, those are intangible assets. And accounting rules say you have to spread the cost of those things out over several years. That yearly cost is an amortization expense.
So it's a non-cash expense. It's not money going out the door today. It's just accounting for a past purchase.
Exactly. It's an accounting cost, not a reflection of how the stores are performing today. So by taking it out, they argue the adjusted number gives you a cleaner comparison of the core business.
And when they make that adjustment, what was the final number?
The adjusted diluted EPS for Q3 was $3.74.
Which is still down from last year.
Still down. Last year it was $3.78. So it's a smaller decline, 1.1%, but it's still negative. So even after you normalize for the acquisitions, the core earnings were still under pressure.
Which brings us to the why. Comps were flat, earnings were down. It clearly missed their own expectations. So let's talk about the CEO's diagnosis. Ted Decker was surprisingly direct.
He was, yeah. He stated, and I'm quoting here, that results missed expectations primarily due to the lack of storms in the third quarter.
The lack of storms.
Yep. He said it resulted in greater than expected pressure in certain categories.
That is a sentence you just don't hear often from a CEO of a retailer this size. It shows a pretty extreme dependency, doesn't it?
It's an incredible look under the hood. Home Depot gets a huge sales bump from natural disasters.
Hurricanes, floods, big snowstorms.
Right. It drives immediate high-margin demand for things like generators, plywood, tarps, all the cleanup supplies, and then later, the rebuilding materials.
So a calm quarter means that entire stream of emergency revenue just vanishes.
It's just not there. And it shows you just how thin their organic growth was, that they really needed that disaster activity to get them over the line.
It's kind of wild that a lack of tragedy is bad for business.
Ugh.
But it wasn't just the weather, right? He also mentioned the broader economy.
Correct. He pointed to two big things: ongoing consumer uncertainty and continued pressure in the housing market. And he concluded that those issues are, quote, disproportionately impacting home improvement demand.
And you can draw a straight line between those two things.
Absolutely.
People are nervous about their jobs, so that kitchen remodel gets put on hold. And high interest rates mean the housing market is locked down, so fewer people are moving.
And when people don't move, two big sources of demand just dry up. You don't have new homeowners spending a ton in the first 6 months, and you don't have sellers fixing up their places to put them on the market.
Right.
That whole cycle just disappears, which is why he can say he thinks they're still gaining market share.
Because the whole pie is shrinking?
The whole pie is shrinking, exactly. It's not that they're losing to Lowe's, it's that the overall demand just isn't there right now.
Okay, let's circle back to total sales then. Because that 2.8% growth figure was so much stronger than the 0.2% comp growth.
Yeah.
The difference has to be acquisitions. So what drove that gap?
It's 100% driven by M&A. Specifically, the recent acquisition of GMS Inc.
GMS.
Total sales included about $900 million just from GMS. And that was only for about 8 weeks of the quarter. So without GMS, their total sales growth would have been almost nothing. They are literally buying growth right now because they can't generate it organically.
And this is a huge strategic pivot for them.
Yeah.
We should spend a minute on why they're pouring billions into these companies like GMS and SRS.
If you just look at the cash flow statement for the past 9 months, you see it. Payments for businesses acquired. It totaled a staggering $5.248 billion.
$5 billion.
They're placing a massive bet that the future of their growth is with the professional contractor, not the DIY customer.
And why the pro? Why now?
The pro market is just more resilient. When the economy gets shaky, you might put off painting the bedroom, but you can't put off a leaky roof.
Right, you have to fix that.
You have to fix it. Contractors are still working on essential jobs, and these acquisitions like GMS and SRS are all about distribution. They help Home Depot get specialized materials to big job sites efficiently. It's something the regular retail store isn't really set up to do perfectly.
So it's a defensive move, a long-term strategy against these exact macro pressures we're talking about.
It's a foundational shift in their business model.
Okay, so let's turn to the future then. Given this flat Q3 and all these pressures, how did they update their guidance for the full fiscal year?
Well, they adjusted it down, as you'd expect. And it's important to remember, fiscal 2025 is a 52-week year. Last year was a 53-week year.
Right, that extra week always messes with the comparisons.
It does, but their guidance is for the comparable 52-week period. So for total Sales growth, they're now projecting approximately 3.0% for the full year.
Okay, 3.0%. But again, how much of that is the acquisition?
That's the crucial context. They expect GMS to contribute about $2.0 billion in new sales to that total.
So wait a minute. If the total growth is 3% and a massive chunk of that is just from bolting on a new company, what does that say about the core business?
It confirms the core is stagnating. Their guidance for comparable sales growth, the health of the original stores, is now just slightly positive.
Slightly positive, so basically zero.
Basically zero. They are almost entirely dependent on M&A for their headline growth number this year.
And what does that do to their profit expectations? All this spending has to have an impact.
It does. The profit outlook is declining. GAAP diluted EPS, that's projected to fall by about 6.0% from last year.
Wow.
The adjusted diluted EPS is a little better, projected to decline about 5.0%. But, integrating these massive new businesses is expensive and it takes time, and that's squeezing their profitability right now.
And what about their operational margins?
Their guidance for operating margin is about 12.6%. The adjusted margin is a bit higher at 13.0%.
And that gap, that 40 basis points.
That's the direct impact of that amortization cost we talked about earlier.
The accounting cost of the acquisitions.
Exactly. It confirms the drag on their reported profits.
Yeah.
And you also see net interest expense is projected at about $2.3 billion for the year. That's the cost of financing all the debt they've taken on.
Okay, beyond the income statement, let's get some context. What about the company's underlying financial strength? Can they actually handle all this pressure and this multi-billion-dollar spending spree?
The cash flow statement is where you look for that. And it provides some really crucial insight.
Okay.
Net cash from operating activities for the 9 months was $12.978 billion.
Which is a huge number.
It is a massive amount of cash. But you have to look at the trend.
What's the trend?
It's down significantly. Last year, in the same period, it was over $15 billion.
So that's a drop of more than $2 billion in cash generation.
Right. And that slowdown confirms the business is facing real headwinds. Less cash is flowing in from the day-to-day business of selling things.
And what about the debt they're using to finance these deals?
The debt load is substantial. Long-term debt is sitting at over $46 billion. Total liabilities are about $94 billion against only $12 billion on stockholders' equity.
So it's a very highly leveraged company.
It is, which is pretty typical for a mature retailer, but it does mean they have less room to maneuver if the market gets significantly worse.
And one last technical thing from their statements.
Yeah.
This idea of working capital outflow. It was a massive number, almost $2.7 billion.
Yeah.
In simple terms, what does that mean?
It means cash is getting tied up in the business instead of being freed up.
Okay.
Working capital is basically the cash you need for daily operations, mostly inventory. A huge outflow like that means they're building up inventory, likely expecting demand that just hasn't shown up yet.
So they bought a bunch of stuff to sell.
And it's sitting on the shelves. Their inventory grew from about $23.9 billion to $26.2 billion year over year. That's cash that's tied up in product, waiting for customers who aren't showing up as often.
Which just highlights the slowdown.
Exactly. It's another key sign of pressure.
So let's step back from all the numbers. What does this all mean for you, the learner?
Yeah.
What we have is the world's biggest home improvement retailer seeing basically flat, stagnant growth in its core business.
Right. And they're not hiding from it. They're explicitly blaming, calm weather, plus the housing market and general consumer nervousness.
And to fight that, they are making these massive, multi-billion-dollar acquisitions, pivoting their entire strategy toward that more resilient pro customer.
Which really raises a huge question that kind of summarizes this whole deep dive. When a major retailer's performance is so sensitive that it's noticeably hurt by a lack of natural disasters,
Yeah.
what does that tell you about the underlying stability of the U.S. consumer and the housing market? We're seeing this clear need to buy other companies just to get any headline growth in what is a very, very subdued environment.
It paints a picture of a company making all the right strategic moves, but they're constrained by these massive forces outside their control.
Completely.
And that leads to our final thought. Considering the company's counting on acquisitions like GMS for a huge portion of its total sales growth, about $2 billion for the year, how long can large retailers really rely on M&A to mask weakness in their core business before they just have to accept a new normal for consumer demand in this high interest rate world? Something for you to mull or explore on your own.